Hi, this is Dr. John Rogers, and welcome to this week's episode of the Financial Independence Podcast. In the past two podcasts, I've talked about term and whole life insurance policies. And this week's podcast, I'm going to tell you about universal life insurance. Universal life insurance consists of a policy that includes a term life insurance component and an investment component. The problem is that the term component costs much more in a universal life policy than it does if you purchase a plain vanilla term policy. Also, the return on the investment component is far less than you would otherwise have received if you'd invested the same amount of money yourself in an investment fund not tied to a universal policy. The reasons for this are the high fees and commissions charged by the insurance companies for managing the investment component of the policy. Universal life insurance first came into existence in the 1980s, when investment returns in financial markets averaged around 10%, whilst whole life insurance policyholders were only getting a return of 3% on the cash value of their policies, even though, as explained in the last week's podcast, insurance companies were investing the premiums of policyholders on their own behalf and making a 10% return. In effect, the insurance companies were pocketing a 7% spread on the premium income received from policyholders. Although policyholders were not aware of these hidden profits that were accruing to the insurance companies, they were keen to move from whole life policies, which were purportedly paying 3% on their cash value accounts, to an advertised 10% return on the investment component of universal plans. Typically, universal life policies allow policyholders to determine their premium and what portion of the premium is allocated to the investment portion of the policy. In this regard, policyholders can choose between investments that involve fixed income instruments like bonds or mutual funds that are mainly invested in equities or stocks that have a variable rate of return. This all sounds well and good, but the problem is the actual 10% returns quoted by the insurance companies was lower than the actual returns because of fees and commissions that were taken out of the premium payments that were being made by policyholders. Companies have been able to scam policyholders because there are no truth in investing regulations or laws that would require that the insurance companies report the effective return as opposed to the advertised return. So you might be wondering why insurance regulators have not stepped in to protect policyholders from this deceptive practice. The reason why regulators have not taken action is because insurance companies are regulated by insurance commissioners who are often ex-insurance company executives, and many of whom once were insurance agents who sold whole life and universal policies. This type of behavior by insurance regulators is referred to as cognitive capture. That is, the decisions of the regulators are biased in favor of those who they are regulating. This type of behavior is also commonly seen in the banking, securities, and commodity regulatory sectors. To add insult to injury, over the last 15 years, interest rates have been very low, and correspondingly, the returns on fixed income investments. This has created a challenging environment for insurance companies to achieve the types of returns on fixed income investments that they were accustomed to achieving in the 1980s. And thus, the actual returns on universal insurance policies to holders have been comparatively low compared to 1980s. Regardless of the actual low returns that were paid to policyholders, the insurance companies continue to collect their high fees and commissions on the premiums paid by policyholders. Additionally, insurance companies invest the portion of the insurance premiums allocated to the life insurance component into treasuries, bills, and bonds. Insurance companies then lend and relend these treasuries out to other financial entities associated with the repo markets and earn an additional income from doing this. However, these profits are not passed on to policyholders. As well, insurance companies routinely tell policyholders that there are yearly increases in the cost of the life insurance component of their premiums over time. Again, this is not true. What actually happens is that as policyholders become older, the insurance part of the premium is renewed every year, and there is an increase in the cost of these premiums every year. So what the insurance companies do is they deduct money from the investment part of the premium to pay for the annual increase in the life insurance part of the premium. In effect, this means that less money proportionally goes into the investment account of the policyholder. Although this is another case of the reality being different from the sales pitch, insurance companies get away with this deceptive practice because the insurance policy clearly states that when you sign the insurance policy, the company is by law bound to the conditions outlined in the policy and not by any false claims or commitments that may have been made by the salesperson. As was explained in previous podcasts, insurance agents are primarily incentivized by their commission base, and as is the case, whenever they sell a universal policy to a policyholder, they receive 80% of the first year's premium, and only 5% goes towards the policyholder's investment account. Furthermore, the annual bonus of each insurance agent is not based on the total face value of insurance policies sold, but on the total value of premiums associated with the insurances sold. Clearly, the agents are more incentivized to sell whole life and universal life policies rather than term life policies. Most insurance companies discourage policyholders from canceling universal policies because of high surrender charges. These fees vary between 30 to 50% of the cash value of your investment account. If a person still wants to buy a universal insurance policy, knowing all of the tricks that I've just described, then they should try and get a policy in which the cost of the premiums paid on the face value are the same as those paid on standard term policies, and no commission is paid on the investment part of the policy, and there is a maximum surrender fee of, say, 6%. Of course, even better still is to buy a standalone term insurance policy and invest the difference between the cost of this and what you would have paid for a universal policy into a mutual fund or low-cost ETF. In this way, the average person would have affordable life insurance coverage that would support their dependents in the event of their untimely demise, and also increase the total value of their investment fund so that they would have enough income and savings to allow them to retire with dignity. So that's it for this week, and thanks for taking the time to view this podcast. If you're interested in becoming more financially independent, then please feel free to subscribe to this channel.